When it comes to investing, there's this one fundamental choice that everyone has to make. It's a question that you've got to answer the minute you decide you want to start building your wealth. And this is it. This is the big one. Should you put all your eggs in one basket, or do you just go out and buy the entire orchard? That's really the core dilemma we're breaking down today, the battle between individual stocks and exchange-traded funds, or ETFs. So first, let's get our terms straight. We need to define the players here. What in the world is an individual stock, and how is it any different from an ETF?
Okay, an individual stock is pretty much what it sounds like. You are buying a piece, a share of a single company. Think Apple, think Tesla. Your entire investment is hitched to the wagon of that one company. So yeah, when it wins, you can win really big. But if it fails, your portfolio is going to feel every bit of that pain. Now, on the other hand, you've got the ETF, and instead of just one egg, this is like buying the entire basket. When you buy just one share of an ETF, say one that tracks the S&P 500, you're not just buying one company. No, you are instantly buying tiny little slivers of hundreds of different companies all at once. You're not just buying one tree. You're buying the whole orchard.
All right, let's really explore that first path, becoming a stock picker. This is the high-stakes, high-reward route. I mean, this is the path that's famous for creating fortunes, but it's also known for some pretty major risks. It's all about going solo, hunting for that one massive winner. And you can see the appeal, right? It's undeniable. The potential for these just explosive returns is huge. You have total control over what you own. And for a lot of people, there's a real thrill of the hunt. It's the challenge of finding that hidden gem before everybody else catches on. And look, this isn't just some fantasy. Think about it. If you had the foresight, or maybe just the luck to invest in a company like Nvidia or Netflix a decade ago, wow, you'd be looking at truly life-changing money today. That's the dream that keeps every stock picker going. But, and this is a big but, here comes the reality check, the risk is just dramatically higher. This is not some casual weekend hobby. It demands hours and hours of serious research. We're talking analyzing balance sheets, tracking industry news, and you gotta have the stomach to handle these wild price swings. One bad earnings report can literally wipe out months of your gains. Okay, but what if that whole high-stress, high-maintenance approach just isn't for you? Well, that brings us to the second path, the ETF, which really offers this powerful safety net through what we call diversification. So the biggest pro for ETFs, hands down, is instant diversification. Since you own a tiny piece of everything in that basket, if one company completely goes belly up, it's not going to sink your whole portfolio. This makes it that classic set it and forget it strategy. It's so much less stressful and requires way less of your time. But of course, there's always a trade-off because your superstar stocks, your winners, are being averaged out with all the laggards in the basket. You're very, very unlikely to see those mind-blowing 1,000% gains. The same diversification that protects you from the big losses also kind of puts a cap on your potential for those massive wins. So, we've seen the two paths. You've got the high-stakes gamble on one side and the broad safety net on the other. Now we get to the most important question of all. Which one of these is right for you? And honestly, the answer really comes down to your personality, your goals, and how much time you're actually willing to put in. Let's break it down. The typical ETF investor, that's often a beginner or maybe a super busy professional who just wants steady, long-term growth with a hands-off approach. But the stock picker, that's someone who genuinely enjoys digging into how businesses work, has a higher tolerance for risk, and is actively trying to beat the market. Which one of those sounds more like you? But hang on, here's the real key insight, the thing that so many successful investors finally figure out. This isn't necessarily an either-or choice. In fact, maybe the most effective strategy of all isn't about picking a side, but about combining the best of both worlds. A really popular and effective way to do this is called a core satellite strategy. So you build the solid core of your portfolio with broad market ETFs. That's your stable foundation. And then you use a smaller chunk of your money to create these satellites, a few high-conviction bets on individual companies that you've personally researched and really believe in. And that brings us right back to that fundamental choice. Are you a basket investor looking for that slow and steady growth? Are you a stock picker out there hunting for those breakout winners? Or are you maybe a strategist who can use the best of both worlds? Knowing who you are as an investor, that's not just some interesting thought exercise, it's the foundation of your entire financial future.